I might characterize it a little bit differently, but a Bank of England analogy, I think, is actually very apt here in that, when the Bank of England votes, it's one person, one vote. And, the governor, who's the equivalent of the Fed chair, has no enormous amount of power to dictate things. And that's very much in contrast to how the Fed has worked for at least the past 50 years, where it's been, I would say, a de facto dictatorship of the chair. And now we have Warsh, presumably not only the most dovish person of the 19-member FOMC, but also with only a couple of others on the Fed who are even, I would say, remotely dovish at this point. And so he probably finds himself in a minority.
Is there a dovish framework going into this meeting? I'm not sure I can find it.
Well, I think, I think the dot plot is likely to show a number of dots that still have a cut or maybe even two appropriate for this year. And that's even with, under the assumption that Warsh chooses not to submit a dot, as has been reported. Now, it's going to be a scatter plot, to be clear. I mean, we're going to have plenty of dots for a hike this year, but I think there are still members of the Fed who are looking for a cut later this year.
If Governor Christoforous was down there, she'd just go like this: "I'm sorry, I'm not submitting a dot."
No, exactly. We're going to get some inflation data tomorrow, David. I mean, I'm just looking at the Bloomberg terminal, the CPI headline, 4.2%. That's not bueno if you're the Fed here at all. I mean, what's going on?
I mean, inflation appears to be actually rising. Now we do actually see at Nomura a fairly soft print tomorrow of 0.2 and more risk of a 0.1 than a 0.3. Really? That's for core. But that really is not what the overall trend is. The trend, especially when you look at the Fed's preferred measure of core PCE, it's 3.3% on a year-over-year basis. And in a couple of weeks, when we get the print for May, we expect that year-over-year basis it to rise to 3.4% on a year-over-year basis. So too high and going in the wrong direction.
So, but the reality is, there's nothing the Fed can do, right? I mean.
Well, the Fed could raise rates, and that would be the classic sort of move that a central bank is supposed to do when inflation's above target. GDP is growing at or above trend, and unemployment is low, and if anything, set to fall a little bit.
Yep. So
we don't think they will, but
but then inflation. I mean, I'll use the term. I don't care. Transitory. I mean, is it because of the war here? And if the war backs off, we got energy coming back down, maybe not to pre-war levels, but certainly coming down, and there you go. We're all set.
I really think this is hard to say that this is transitory, especially when you look at core inflation. So headline inflation, which the Fed doesn't concentrate as much on, there you can make a very good argument. But when you look at how much the Strait of Hormuz and the energy price bump is hitting core inflation, probably no more than 0.1% or so. So that's pretty small. I think what we're seeing is a much more classic sort of Econ 101 overheating of the economy, where there's a huge amount of, one could say, price insensitive demand from hyperscalers for everything chip related. And that is outstripping supply. And therefore, with demand outstripping supply, prices are rising. And I think it's really hard to make a case that this is Strait of Hormuz related again. And key thing here, inflation on a core basis would be at or very close to the level it is right now, even had the Strait of Hormuz not ended up being closed, we think.
Okay. That's really interesting. That's controversial.
If I'm Mr. Warsh, I'm like, now what do I do?
I mean, come on, they just did an honorarium for John B. Taylor out at Stanford, one of my first supporters. And we have this architecture of certitude of a 2% inflation. Where did that go? I mean, we are miles from a trend line 2.x% statistic.
Yeah, this is going to be the 6th consecutive year with the
What
inflation
would Martin
target.
Feldstein say? You had the privilege. I knew Martin, Professor Feldstein, well, we grieve his loss every day. You worked the grind with Feldstein. What would he say?
He certainly is missed, and I think he would almost certainly be calling for rate hikes at this point. And so, I think the dovish argument that Warsh and others who are doves will make is that They see disinflation coming because of the fading of the tariff effect, because of AI being disinflationary. But we've heard these arguments year after year now for 6 years, and where are we? We're again well above target, and if anything, moving in the wrong direction on inflation.
Paul, this is serious stuff. I mean, we're benumbed by it. Paul and I are numb. Alexis is not numb because we have Tito's and Tang on this side of the studio, but I mean, this is serious stuff.
Serious inflation, and I don't see it going anywhere. Labor market. What's your sense of the labor market?
Labor market is in somewhat of a Goldilocks zone. So obviously we got a fantastic print just last week. Now, if we took that print just at face value, the NFP, I mean, it would actually look like the labor market might be overheating. A lot of that stuff was temporary. So we had a big bump in state and local. That's probably just a statistical noise sort of thing. And then leisure and hospitality, that may well have been related to the upcoming World Cup. So that's unlikely to be keep going.
Right.
But still, even taking those out, we're sort of right where we want to be at low 100,000 sort of jobs. And